If a book can change the way you see the world, this is where you'll find it. I'm Karo Chen. Let's explore together the books that truly shape our destinies. Today, the book we're diving into is The Island Economics. Have you ever been confused like this? You're clearly saving money, but somehow your wallet keeps getting thinner? The news says the economy is growing, yet your salary hasn't moved an inch. You open an economics book and it's full of terms like GDP and quantitative easing, enough to make your head spin. Does understanding life's money game really require mastering formulas? Actually, economics isn't that complicated at all. In The Island Economics, the author says economists have simply made it sound way too complex. The genius of this book lies in its simplicity. It uses one minimal story to explain the entire logic of human economics, from catching fish by hand to financial crises. The story starts off very simply. On 3 small islands, Abel, Baker, and Charlie catch fish by hand every day. One fish is just enough for one day's meal. No savings, no loans, and definitely no economic policies. Life is simple, but fragile. If they don't catch fish, they go hungry. It may sound primitive, but this is exactly where all economics begins. The money we use today, the houses we buy, the stocks we trade, they all trace back to how these 3 islanders figured out how to get food, save surplus, and live better. What makes The Island Economics brilliant is how it strips away all the flashy real-world packaging, removes the complex financial jargon, and lets us touch the raw bones of the economy. So let's start right from the beginning of this island story. What secret is hidden in Abel's fishing net? How did fish turn into money? And why did money lose its value? After the government stepped in, how did the island's good days slowly fall apart? You'll realize that the big questions experts argue about all come down to one simple thing: how these 3 primitive men managed to catch more fish. Because at its core, the essence of economics has never changed. It's all about helping people live a little more securely than they did yesterday. If we say the economy is like a big tree, then what are its roots? The Island Economics tells us, through the most primitive scene, that the roots are the courage to go hungry today, and the wisdom to make sure you don't go hungry tomorrow. The story begins simply. Abel, Baker, and Charlie, 3 islanders, repeat the same thing every day. They dive into the ocean and catch fish with their bare hands. One fish is just enough for one person for one day. No more, no less. This is the most primitive economic state. No savings, no investments. Everyone's trapped by the question of whether they can eat today, with no time to think about anything else. But humans always have desires. One night, Abel looked up at the stars and thought, "Is this really it? Am I going to spend my whole life catching fish?" He wanted to make a decent outfit out of palm leaves, build a small shelter to keep out the rain, maybe even make a little island documentary. But all of those dreams required time, and all of his time was spent catching fish. Then suddenly, Abel had an idea. What if I could make something to catch fish faster? He thought of a fishing net, twisting palm bark into ropes to weave a net that could trap fish. It sounded simple, but hidden inside was the first secret of economic growth. Abel decided to make the net, but weaving it would take a full day, meaning no fish to eat that day. Baker and Charlie laughed at him. "Are you crazy? You're starving yourself for a piece of rope? What if it doesn't work? You'll have nothing to eat tomorrow either." But Abel stuck with it. He went hungry, twisting rope and weaving his net, lying awake that night with an empty stomach, feeding himself on dreams of future fish. The next day, the net worked. In just 1 hour, he caught a fish. And by the end of the day, he had caught 2. This simple story hides one of the core ideas of economics. Capital doesn't fall from the sky. It comes from delayed consumption. Abel's net is capital. You can't eat it, but it helps you catch more fish. To make the net, Abel had to sacrifice his daily meal, delaying consumption, and take the risk that the net might not even work. This is true of every leap in human progress. When early humans made stone tools, they had to stop gathering fruit. When farmers built plows, they had to go hungry and save wood. When factory owners built plants, they had to resist spending on pleasures. No one gets productive tools without paying a price. And that's the starting point of all economic growth. Bitter first, sweet later, not the other way around. With his net, Abel could now catch 2 fish a day. Eat one, save one. Baker and Charlie, watching him, got jealous. They wanted nets too, but they didn't want to go hungry. So Baker proposed, "Abel, lend us one of your fish. Once we finish our nets, we'll pay you back too." Abel hesitated. He could save the fish for himself, or lend it out. If he lent it, there was a risk that they might fail to make the nets. But if they succeeded, the island's total fish supply would grow. He chose to lend. Baker and Charlie used the borrowed fish to survive their net-making day, and soon they too were catching 2 fish a day. Now the island's daily fish output rose from 3 to 6. Everyone was better off. Here lies the second key principle. The value of saving is that it allows resources to flow toward people who can create more value. If Abel had eaten his fish, he'd still only have 1. But by lending it to Baker and Charlie, that fish became 2, because they used it to make nets, creating more output. That's the essence of lending, not exploitation, but cooperation. Just like in real life, banks lend depositors money to entrepreneurs to start businesses. When the entrepreneurs make profits, they repay with interest, and banks share that interest with depositors. Everyone benefits because the resources were used productively. But if Abel had lent his fish to Baker just to go on vacation, to eat the fish without making a net, the outcome would have been totally different. Baker would have eaten the fish, produced nothing, and had nothing to repay. Abel's savings would be gone, and the island's total fish supply wouldn't grow. That's why borrowing itself isn't the problem. The problem is what you borrow for. After that first success, Abel became the island's banker. But he soon realized not all borrowers were the same. The first type was a productive loan, like someone borrowing fish to build a giant fishing machine that could catch 20 a day. That was worth lending. The second type was a consumption loan, someone borrowing fish to go surfing, promising to pay back later. Abel refused. The third type was an emergency loan, someone sick and unable to fish for a few days, borrowing fish to survive. That Abel agreed to. These 3 loans mirror the 3 types of borrowing we see in real life. A business loan is a productive loan. It generates income. A credit card used for shopping or travel is a consumption loan. It just piles up debt. Borrowing for medical emergencies is an emergency loan. It's a necessary lifeline. Unfortunately, many people get this backwards, treating consumption loans like benefits and productive loans like burdens. As the island's fish output rose from 3 to 6, then to 20 per day, Abel, Baker, and Charlie finally had more fish than they needed. They started thinking about living better, building shelters, making clothes, learning to surf. But then, a new problem appeared. Bartering was too inconvenient. If someone wanted clothes, they had to carry fish to the tailor. If they wanted to learn surfing, they had to bring fish to the instructor. So people started realizing they needed something everyone would accept as a common medium of exchange: money. And that led to the next stage of the economy. When saving and investment boost production, money naturally appears. It makes trade easier, but also brings new problems. Will the fish lose their value? And that's where we're heading next. When fish turn into money, how does the economy become more complex, and what hidden risks start to grow? As fish became more abundant on the island, Abel and his friends finally didn't have to worry about filling their stomachs every day. Some people built sturdy huts, others started making palm leaf clothes, and someone even began teaching surfing. The division of labor became more specialized and trade more frequent. But a new problem appeared. Barter was just too troublesome. For example, Duffy, who built canoes, wanted to trade a boat for some new clothes. But the person making clothes happened to want fish, and the one with fish wanted a surfboard. The 3 had to find each other at the same time for the trade to happen. Miss one person, and the deal fell apart. It was too hard to match up like that. So everyone thought they needed something everyone would agree had value. Something to act as a middleman in trade. Eventually, everyone turned to fish. After all, everyone needed to eat. and everyone had a sense of how much a fish was worth in clothes or wood. And just like that, fish became the island's currency. But no one realized that this simple invention, meant to make trade easier, would later bring a whole set of new problems. Fish could serve as money not because it was special, but because everyone believed it had value, just like how we use the yuan or the dollar. The paper itself isn't valuable, it's the shared belief that gives it power. But for a currency to stay stable, one thing must hold true. The amount of money must match the amount of real wealth. If the island caught 100 fish a day, there could only be 100 fish worth of currency in circulation. If someone secretly cut a fish in half and sold it as 2, it might look like there was more money, but the real amount of fish hadn't increased. In the end, each fish just became worth less. That's the seed of inflation. At first, the island's fish currency worked fine. People used it to hire workers to build huts or to buy materials for better fishing tools. Money acted like oil in a machine, helping resources flow to where they were most needed. Builders could focus on building, and fishers could focus on fishing. Productivity across the island went up, but once fish money turned into fish reserve notes, paper currency, the game changed. Some people realized printing money was a lot easier than catching fish. All you had to do was make more paper to trade for someone else's hard-earned catch. That shortcut thinking became the root of future trouble. With money in play, the market became livelier. Duffy's canoe story is the best example of how a market works. At first, it took him 5 days to build one canoe by hand, meaning he had to give up catching 10 fish. So he sold each canoe for 10 fish, just enough to break even. Later, after saving up, he made himself a woodworking knife. Now he could finish a canoe in 3 days, cutting his cost to 6 fish per canoe. He lowered the price to 8 fish, still earning 2 fish of profit, while buyers saved 2 fish compared to before. That's the beauty of improved efficiency. Producers make money, and consumers save money. Even better, when other builders saw Duffy's success, they copied his idea and made their own knives. Soon, everyone could build a canoe in 3 days. Competition pushed prices down to 6 fish, covering only the cost. No one made extra profit, but everyone on the island could now afford cheaper boats. That's the magic of the market. Competition forces everyone to get better, and in the end, everyone benefits. It's the same reason why phones and computers keep getting cheaper. Not because companies turned kind, but because innovation and competition make production more efficient. But some people didn't get it. They thought falling prices were bad, like it meant merchants were losing money. They forgot that if Duffy had never made that woodworking knife, everyone would still be paying 10 fish for a boat. Falling prices aren't scary. What's scary is having nothing to buy. Over time, the islanders caught more fish than they could eat. Some wanted to save the extra. But fish went bad after a while and could be stolen. That's when a man named Max spotted an opportunity. He built a temperature-controlled storage room and opened a business. He reassured everyone, "Don't worry, I'll keep your fish safe, and I'll even pay you a little interest." Meanwhile, he lent the stored fish to people who needed them and charged a higher rate, earning the difference. The bank's real job was to gather scattered savings and lend them to people who could make those resources grow. For instance, if someone wanted to build a giant fishing machine that required 100 fish, but didn't have enough, the bank could gather 10 fish each from 10 savers and lend them together. Once the machine was built, it could catch 20 extra fish per day. The borrower would repay 120 fish, principal plus interest. The bank kept 10 as a fee and gave the remaining 10 to the savers. Just like that, savings turned into more wealth. But banks had a fatal weakness. They couldn't lend recklessly. If Max lent fish to some fraud who claimed he could catch fish with hypnosis and couldn't pay it back, then when depositors came to withdraw their fish, the bank wouldn't have enough. That's what we call a bank run. In real life, during the 2008 financial crisis, many banks nearly collapsed for the same reason. They lent money to people who couldn't repay their mortgages. Unfortunately, later bankers forgot this rule. Once fish reserve notes, paper money, replaced real fish, banks realized printing money was easier than managing it. After all, depositors withdrew paper, not real fish. As long as no one noticed there weren't enough real fish backing the notes, They could keep printing forever. That laziness planted the seeds for future crises. Once fish turned from real wealth into printed paper, and banks from capital managers into money printers, the market's balance broke down. Some people realized they could print money to buy others' hard work, so why bother fishing or making tools? Others figured they could just borrow endlessly, since new money could always patch the hole. Even worse, the government got in on it too. Speaker Frankie, eager to please voters, began printing money for welfare, handing out fish coupons to the jobless and subsidies to builders. On the surface, everyone had more money, but the number of real fish hadn't increased. The result? More and more money, smaller and smaller fish. Prices shot up, and people's hard-earned savings quietly lost value. And now we finally see, money and markets themselves aren't the problem. The real problem comes when people mistake money for wealth, and printing money for creating it. When governments start believing they can solve everything by printing more, and banks forget that savings must be backed by real production, the island's golden days are numbered. In the next part, we'll see what happens when the government fully steps in, when the visible hand tries to control the market. What kind of bubbles and crises will that bring? That's what we'll uncover next. When the government arrives, why does the economy start to fall ill? When life on the island got better and better, a new player showed up, the government. At first it was like a quiet night watchman, just keeping order. But slowly its hands reached further and further, until one day it dipped right into the fish tank, stirring up what used to be crystal clear water. In the very beginning, there was no government at all. Abel, Baker, and Charlie settled disputes through understanding, and when pirates came, they fought side by side. But as the population grew, so did the problems. Fish thieves, land grabbers, even invaders from other islands. Eventually, everyone sat down and agreed. They needed a public institution to handle all that. So they elected 12 senators and founded the nation of Masonia. The government's job was clear. First, build a navy to fight pirates. That's defense. Second, set up courts to settle disputes. That's justice. Third, build lighthouses to prevent shipwrecks. That's public infrastructure. Where'd the money come from? Everyone paid some fish as taxes each year. And those taxes were used wisely. Lighthouses made shipping safer. The Navy made fishing safer. In the end, the island's efficiency actually went up. At that point, the government was like a waiter. It took your money and did the job, nothing more. But the real problem was the boundary. What should the government handle? Building lighthouses, sure. But handing out fish to people who didn't have any, does that count? What about helping someone borrow money to build a hut? Is that the government's job too? At first, the senators kept things clear. Taxes were limited and had to be spent where everyone benefited. But then someone figured it out. The more things you control, the more votes you get. It's like giving kids more candy. They'll like you more, even if too much candy rots their teeth. The story goes on. When Frankie Deep became speaker, he completely broke the rules. He realized that raising taxes made people angry, but printing money? No one complained. As long as he printed some fish reserve notes, paper money supposedly backed by real fish, he could exchange them for people's labor out of thin air. At first, each note was still backed by real fish. 10 notes meant 10 fish stored in the bank. But Frankie wanted welfare programs. He wanted to hand out notes to the jobless, to subsidize people building huts. When there weren't enough real fish, he quietly cut one fish into 2 official fish. The books still looked fine. When depositors came to redeem their fish, they noticed the fish were smaller and smaller. Frankie just said, "This is our fish value enhancement plan." Even the scientists chimed in. Smaller fish are healthier. And that right there was the truth of inflation. When the government printed more money than there was real wealth, the money itself became cheaper. It's like this. Your $100 used to buy 10 pounds of fish. Now it only buys 5. Did fish get expensive? No. Your money got quietly cut in half. Even worse, the government forced the banks to play along. Old banker Max tried to stop it, warning that real fish were running out. But Frankie kicked him out and replaced him with a yes man named Allie Greenfin. Greenfin said, "Don't worry. We've got the Fish Reserve Deposit Insurance Company. Everyone trusts us." In other words, they used government guarantees to fool people into feeling safe while their savings kept shrinking. The government didn't stop at printing money. It stuck its hand into the loan market too. People complained that poor folks couldn't get loans to build huts. So Senator Cald came up with Hut May and Hut Mac, government-backed housing loans. Now banks were happy to lend to anyone, even those with no savings or income, because if things went bad, the government would bail them out. The banks were thrilled. They used to check if people could repay. Now they didn't bother. They made profits on interest, and if they lost money, the government covered it. The result? Everyone rushed to borrow and build huts. Demand soared. Prices went crazy. People thought buying a hut was a sure win, even if they couldn't afford it. After all, the government guaranteed it. Banks didn't dare collect too hard either. That's how market signals got distorted. Normally, no one would lend money to someone who couldn't pay it back. That's how the market clears out the landmines. But once the government stepped in, those landmines got covered up, and even treated like treasures. Just like in real life, when Fannie Mae and Freddie Mac guaranteed subprime mortgages in the US, it blew up into the 2008 financial crisis. The island's hut bubble was no different. The government also loved big projects. Someone suggested building a water plant. Sounded great, but only if it cost less than it produced. If they just wanted to create jobs, like paying people to polish rocks all day, spending 100 fish to earn only 50, that was pure waste. Those fish could have been used to make new fishing tools and create real wealth, but the senators didn't care. As long as they were spending, they thought they were stimulating the economy. Even if the projects were useless, at least someone got paid in fish. That kind of spend for the sake of spending thinking is like feeding sugar to a starving man. He'll feel better for a moment, but it adds no nutrition. In the end, he only gets weaker. Once the government got a taste for printing money and interfering, it couldn't stop. After Frankie, Speaker Lindy launched unemployment fish vouchers. Then Speaker Okuda pushed the American Camel Project, replacing donkeys with new animals. Nobody actually needed any of it. But the excuse was always the same, to stimulate the economy. But here's the truth. Real wealth comes from production, not from printing or spending. The island only had so many real fish. The more notes the government printed, the less each one could buy. The more huts they built, the more empty huts sat unused. People saw more vouchers in their hands, but fewer goods they could actually buy. That's fake prosperity, lively on the surface, hollow inside. Even scarier, the government started justifying itself. Ally Greenfin said, "Inflation is good. It makes people spend more." Frankie said, "Smaller official fish show progress. It means we're more efficient." Just like in the real world, economists say, a little inflation is healthy, and politicians say, deficits aren't dangerous. They wrap mistakes in fancy jargon until ordinary people actually believe them. When the government stopped being a rule-following waiter and became the boss of everything, the fish tank was ruined for good. It printed money to dilute savings, gave guarantees that encouraged waste, used projects to hog productive resources, and never let the market fix itself. It was like someone dumping random spices into the fish tank. The fish were bound to get sick, and soon, all those hidden landmines would blow up. Too many huts, unpaid loans, printed money no one trusted. When the fake prosperity finally collapses, the island will face a massive crisis. And that's what we'll talk about next. When the bubble bursts, no one gets out unharmed. When the island's housing boom hit its peak, no one believed the good times would ever end. Everywhere you went, people were talking about how buying a hut could make you rich overnight. Bankers were busy bundling hut loans into fancy funds, and even the poorest islanders were borrowing money to buy a second vacation hut. But just like the tide always goes out eventually, this prosperity built on printed money and easy credit was bound to expose the rocks underneath. The burst of the bubble often starts with just a small sign. The island's most luxurious volcano view villa project, boasting both volcano and ocean views, suddenly stopped selling. The developer couldn't repay his construction loans. The guarantor, Manny, the island's biggest investor, was the first to collapse under his own properties. The loan funds turned into bad debt, and panic spread like a virus. People who once believed hut prices would only rise, borrowing just to get in, were now desperate to sell before losing more. But when everyone wants to sell and no one wants to buy, prices crash. Huts that gained 10 fish in value a day now dropped 20. Someone who bought a hut for 100 fish in the morning found it worth only 50 by afternoon. Worse yet, those who had bought huts with zero down payments, people who had no savings and relied entirely on loans, started defaulting. With hut prices crashing, they simply walked away, leaving the mess to the banks. The banks repossessed a pile of empty huts nobody wanted. The loan certificates in their hands turned into worthless paper. The government-backed mortgage guarantors, Pengleme and Pengleme, went bankrupt too. The entire financial system collapsed like a line of dominoes. The collapse didn't stop at the housing market. The hut builders, the shop owners selling construction materials, even the craftsmen fitting glass windows, all lost their jobs. Even the donkey cart company suffered. People who could once afford a 5-donkey luxury cart now had to walk. Donkey carts rusted away in warehouses. Unemployment skyrocketed, and the streets filled with angry islanders demanding answers. Faced with the crisis, the senator's first reaction was to increase the dose. Speaker Bass launched an emergency bailout plan, injecting funds into big corporations, backstopping Manny's failed fund, and printing piles of fish reserve notes to hand out to the unemployed, saying spending would save the economy. But these were all Band-Aid fixes. Bailing out big firms meant using taxpayers' fish to plug bad debt holes. Handing out coupons let people buy fish temporarily, but created no new fish. The island's fishing output didn't grow, and the more coupons they printed, the fewer fish each coupon could buy. When Speaker Okuda took office, he doubled down. He launched the Donkey for Carp plan, subsidizing new donkey carts, built a lighthouse in the shady swamp where no one ever went, and even handed out grants to surf schools to boost consumption. These projects seemed to create jobs, but in reality were just spending for spending's sake. The lighthouse served no purpose. New carts were sold, but no one could afford to drive them, because oil prices rose faster than cart prices, and the surf school graduates still couldn't find jobs. The most absurd policy was quantitative fissioning, what we'd call quantitative easing. Ben Bernanke, the head of the Fish Reserve Bank, said, "If we just print more coupons and buy up all the huts, prices will recover." So shiploads of coupons were sent to Wharf Street, the island's financial hub. Sure enough, fund prices went up, and the housing market stabilized for a while. But people forgot. Those coupons weren't backed by real fish. What rose was just the numbers, not real wealth. The island's fake prosperity had long depended on lifelines from the Central Island Empire. The empire's people worked hard, catching fish and making goods, to trade for fish reserve notes, which they then deposited back into the island's banks, allowing the island to keep borrowing and consuming. But over time, they realized those notes were losing value. The more they saved, the more they lost. One farmer said to the emperor, "Why are we sending them fish just to get paper in return? Can't we just make our own bowls and use them ourselves?" The emperor woke up and ordered that from now on, they would only accept real fish, not fish reserve notes. And just like that, the island's money supply was cut off. The Central Island Empire had been the biggest buyer of fish reserve notes. Once they stopped buying, the note's value collapsed. Where one fish once traded for 10 notes, now it took 100 notes to buy a single fish. Imported goods, like the empire's carts and Dance Island sunscreen, became outrageously expensive. Store shelves emptied day by day. The senators panicked, shouting about a strong fish policy to restore value to the notes. But shouting didn't work. So they printed even more, hoping to stack quantity into value. The result? More notes, smaller fish. Someone who earned 100 fish notes in the morning found by noon they could only buy half a coconut. This was hyperinflation. money turned into waste paper, and people went back to bartering fish for goods, just like in the beginning. The root of the crisis had been hidden in that fake prosperity all along. Everyone mistook rising hut prices for real wealth, forgetting that huts can't be eaten or worn. They only have value when someone's willing to trade real fish for them. The government treated printing money as economic growth, forgetting that money is just a tool. Without fishing and tool-making, it has no foundation. The whole island was addicted to borrowing and spending, forgetting that borrowed fish must eventually be repaid, with interest. When the bubble burst, all those problems surfaced. Savings vanished. People's fish either turned into devalued huts or were inflated away into worthless paper. Production collapsed. No one wanted to fish or make tools anymore, because printing notes was easier and speculation paid better than real work. And trust disappeared. No one believed in the fish notes, the government, or even that hard work could bring prosperity again. In the end, the Central Island Empire came to scoop up the leftovers. They used real fish to buy the island's water plant, lighthouse, and even the giant fishing machine. They took away everything that could create real value, leaving behind a pile of worthless fish notes no one wanted. Standing on the empty pier, Senator Okuda finally asked the one question that mattered. Who still knows how to weave a fishing net? We'll have to catch our own fish again. This crisis tore off every disguise. Prosperity without production is nothing but a bubble. Relying on money printing and borrowing to stay alive only makes the crash worse. The island's lesson is a mirror of reality. When a nation becomes addicted to debt, consumption, and speculation instead of saving, producing, and innovating, it will inevitably end up the same way. But crisis isn't the end. After the Central Island Empire turned inward, making and consuming their own goods, life slowly improved again. The small island, though back to square one, saw people start weaving nets and fishing once more, rediscovering that old truth. Even when you're hungry, you must still save and build capital. That brings us to the final question. What can we learn from this island's crisis? How do we avoid repeating the same mistakes? In the next part, we'll talk about this, because the essence of economics has never changed, and the things that truly make life better have always been the same few. When you close the island economics, you'll realize economics was never that complicated. The logic of living a good life isn't that different from Baker building boats or Charlie going surfing. At the end of the day, it all comes down to a few simple island rules and avoiding the traps that make life harder. First, be like Abel. Go hungry to weave your net. Saving gives you confidence. Delaying gratification shows wisdom. Abel's greatest strength wasn't just that he made a net. It was that he had the courage to go hungry for a day to make it. For ordinary people, that's what saving really means. Not spending everything now, but keeping a part for your future fishing net. Some say, money loses value too fast. Saving is pointless. But the island story tells us that what loses value is printed paper, not real savings. Abel saved fish, real wealth. Even when the fish currency shrank later, his net remained, and so did his ability to fish. For us, saving doesn't always mean cash. It could mean learning a skill, buying a set of tools, or saving up to start a business. These are the kinds of capital that help you catch more fish, and they're the best defense against inflation. Delayed gratification isn't self-punishment. It's about not being controlled by life. Second, know the difference between debt for nets and debt for vacations. Don't let debt become a shackle. When Baker and Charlie borrowed fish to make nets, that was productive debt. They ended up with more fish. But borrowing fish for a vacation? That's consumer debt. You just end up poorer. For regular people, this is the debt philosophy everyone should understand. The same goes for mortgages. If you take one to have a stable home and the monthly payment is under 30% of your income, that's healthy. But if you're using credit cards or loans to buy luxury bags or vacations, you're just eating tomorrow's fish today. You'll go hungry sooner or later. Remember, debt itself isn't scary. What's scary is when it doesn't help you earn more. Some people borrow to learn programming and double their income later. Others borrow to show off with a luxury car and end up crushed by gas and maintenance costs. That's the difference between good debt and bad debt. Third, see the truth behind shrinking fish money, and don't be fooled by fake prosperity. In the later part of the island's story, the fish currency kept getting smaller, but the senators called it economic growth. In real life, prices rise every year, and people call it development. But remember, money doesn't lose value because things got expensive. It's because too much money was printed. The way ordinary people fight this isn't by chasing whatever others say will go up, like those huts, but by holding on to real value. Just like Duffy, who always earned a living with his woodworking knife, his core skill. Doctors rely on their healing skills, chefs on their craft, coders on their code. These fish-catching abilities are always more reliable than chasing trends or hype. Don't believe in the myth of getting rich without effort. Fourth, don't swallow every sweet deal from the government. There's no such thing as a free lunch. Senator Frankie handed out fish reserve coupons as welfare. It looked like everyone benefited, but in the end, everyone's fish just got smaller. Government stimulus and subsidies may look like they're helping people, but really, they're just using everyone's money to do everyone's business, and when it fails, everyone pays the price. Finally, the essence of economics is simply living steadily. From fishing with bare hands to the bursting of the bubble, the island went full circle before realizing what truly improves life isn't printed money or inflated house prices. It's catching more fish, wasting less, saving wisely, and working steadily. For us, the logic of a good life is the same. Stop chasing shortcuts. Learn to weave your own net first. Don't be dazzled by fake prosperity. Hold on to real productivity. Don't let debt tie you down. Know the difference between wants and needs. After all, the end of economics isn't some complicated formula. It's a truth every ordinary person can understand. If you're willing to suffer a little today for tomorrow, tomorrow will always be steadier than today. And that's the simplest wisdom of the island's logic. Congratulations. You've just finished another great book.